You check your portfolio, it's up 3% today. You feel fine. Maybe you smile, maybe you don't even tell anyone. The next week, it drops 2%. And suddenly, you're refreshing the app, you're calculating how much you just lost, you're wondering if you should sell. Same portfolio, smaller loss, bigger emotion. This isn't a personality flaw. It's not because you're pessimistic or bad with money. It's because your brain is running software that was never designed for stock markets. And once you see how this works, you can't unsee it. Here's a thing nobody tells you about investing. The math is symmetrical, but the feeling never is. Let's say you put $10,000 into an index fund. One day it goes up 5%. You just made $500. That's rent. That's a weekend trip. That's real. The next day it drops 5%. You just lost $500. On paper, these events are identical. Same percentage, same amount. If they happened back to back, you'd be exactly where you started. But that's not how it feels, not even close. The gain feels like a nice surprise, a small win, something pleasant that happened in the background of your life. The loss feels like a problem, something that requires your attention, something that might get worse. And if you've ever invested real money, you already know this. You've lived it. The question is, why? Why does your heart rate spike when you see red but barely moves when you see green? Why can you be up 20% for the year and still lose sleep over a bad week? Why does a market correction feel like a catastrophe even when you know intellectually that it's completely normal? The answer isn't in the market. It's in you. In the 1970s, two psychologists named Daniel Kahneman and Amos Tversky started asking people to make bets. Simple gambles, coin flips, hypothetical scenarios. What they found broke the model of how economists thought humans made decisions. Here's one of their experiments. They asked people, would you take a 50-50 bet where you either win $150 or lose $100? Most people said no. Think about that. The expected value is positive. You should take that bet every single time if you're thinking mathematically, but most people wouldn't. They needed the potential gain to be about twice as large as the potential loss before they'd even consider it. Kahneman called this loss aversion, and the ratio held across hundreds of experiments. Losses hurt roughly twice as much as gains feel good. This isn't a bug, it's a feature. 10,000 years ago, if you found a bunch of extra berries, that was nice. You'd eat well for a few days, maybe share with your tribe, build some goodwill. But if you lost your shelter or your stored food or got injured, you could die. The upside was capped. The downside was existential. So evolution built a warning system. Your brain learned to treat losses as threats. Red means danger. Red means pay attention. Red means do something. Even now, even when the red number on your screen has nothing to do with your survival, your brain doesn't know the difference between losing $500 in your brokerage account and losing 500 calories worth of food in the winter. It just knows something bad happened, and it lights up the same neural circuitry. The amygdala fires, cortisol gets released. Your body prepares for a threat that doesn't exist. The problem is that the stock market doesn't care about your neural circuitry. It doesn't matter that you're scared. It doesn't matter that you're paying attention. The market is going to do what it does regardless of how many times you refresh the app. But your brain keeps screaming at you anyway. Here's where it gets worse. Loss aversion doesn't just make red days feel bigger. It makes you miscalculate probability. Let's say you're up 10% for the year. That's a great return, better than most years historically, better than inflation, better than bonds, better than leaving your money in a savings account. But when the market drops 3% in a week, it doesn't feel like you're still up 7%. It feels like you're losing, because your brain isn't tracking total return. It's tracking change from the last time you checked, and loss aversion magnifies that change if it's negative. So you get this weird effect. You can be winning and still feel like you're losing. You can have more money than you started with and still feel anxious. Psychologists call this reference point dependence. Your brain doesn't evaluate outcomes in absolute terms. It evaluates them relative to where you just were, which means every time you check your portfolio, you create a new reference point, a new baseline. And if the next number is lower than that baseline, your brain treats it as a loss, even if you're still up overall, even if nothing has actually gone wrong. Now add in another problem: frequency. The more often you check your portfolio, the more often you see red, because markets go down all the time. Not in a catastrophic way, just in a normal, random, any given Tuesday kind of way. If you check once a year, you'll probably see green. The S&P 500 has been positive about 70% of all calendar years since 1950. If you check once a month, you'll see red about 40% of the time. If you check once a day, you're looking at a coin flip. The market closes lower than it opens roughly half the time. And every time you see red, you feel that little jolt, that little spike of loss aversion. You're not seeing more losses. You're just seeing the same variance chopped into smaller pieces. But your brain treats each piece like a new event, a new threat. This is why people who check their portfolios obsessively tend to underperform people who check them rarely. Not because they make worse decisions, in theory, but because they feel worse more often. And feelings drive decisions. The only difference was how often they got updates. One group saw their portfolio performance once a year. The other group saw it once a month. The yearly group invested more in stocks. The monthly group shifted towards safer assets. Not because the fundamentals changed, but because they experienced more emotional volatility. They felt more losses, even though the actual losses weren't any bigger. The financial industry knows all of this. They've known for decades, and they've built an entire infrastructure around making you look. Push notifications when the market moves, real-time price updates, red and green everywhere, apps that gamify investing and send you confetti when you make a trade. They'll tell you it's about empowerment, transparency, giving you control. But the more you look, the worse you feel. And the worse you feel, the more likely you are to do something. Trade, adjust, move money around, which is exactly what they want. Because every time you do something, someone collects a fee. Schwab makes money when you trade. Robinhood makes money when you trade. Even Vanguard, the supposed good guys, benefit when you move assets around. The entire system is designed to create the illusion of control, while exploiting the fact that control makes you worse off. Here's the irony. The best investors in the world don't check their portfolios constantly. Warren Buffett has said he doesn't care what his stocks do day to day. He cares what the businesses do year to year. Charlie Munger used to say the big money isn't in the buying or the selling, it's in the waiting. But he's not the target market for these apps. You are. And they know exactly which buttons to push, because the buttons are hardwired into your brain. Now, zoom out. This isn't just about your portfolio. It's about how you process risk in every part of your life. You remember the bad reviews more than the good ones. You remember the criticism more than the praise. You remember the layoffs in the news more than the hiring reports. You remember the friend who betrayed you more vividly than the 10 who showed up, because your brain is asymmetric. And in a world that's designed to flood you with information, this asymmetry gets weaponized. The news cycle runs on loss aversion. Every headline is a threat. Every alert is something you need to worry about. Because worry drives clicks, and clicks drive revenue. Social media runs on it too. The algorithm knows that outrage keeps you scrolling longer than joy. That fear keeps you engaged longer than hope. The same mechanism that makes a 2% red day feel bigger than a 3% green day makes you think the world is falling apart when the data says it isn't. Crime is down. You feel less safe. Lifespans are up. You feel more anxious. Poverty is declining. You feel like the economy is broken. Markets hit new highs. You feel like you're about to lose everything. It's not that the good things don't exist. It's that your brain wasn't built to weight them equally. And the people designing your apps know that. They're not trying to give you an accurate picture of reality. They're trying to hold your attention. and loss aversion is the most reliable way to do it. So what do you do with this? You can't rewire evolution. You can't turn off loss aversion. It's older than language, older than agriculture, older than every financial market that's ever existed. It kept your ancestors alive. It's the reason you're here. But you can't stop pretending the feeling is the same thing as the reality. When you see red and your chest tightens, that's information, but it's information about your nervous system, not about your future. The market doesn't care how you feel. It doesn't move because you're watching. It doesn't stop because you're scared. And the gap between what hurts and what matters is where most people lose. Not because they don't understand investing, but because they understand their feelings even less. Here's what's crazy. You probably already know most of this. You've probably read about loss aversion before. You've probably heard that you shouldn't check your portfolio every day. But knowing doesn't fix it. Because this isn't an intellectual problem, it's a physiological one. Your body is going to react to red numbers whether you want it to or not. Your amygdala doesn't care that you've read the research. It's going to do its job anyway. The only question is whether you let that reaction dictate your decisions. You're going to see more red days. That's not a prediction. That's just math. And every single one of them is going to feel bigger than it is. The question isn't whether you can change that. The question is whether you'll let it change you.